All right. So, good morning. Today we'll be starting the financial sector. All right. Financial market actually. Financial sector is already going on. Financial market. Right. Look, when we call look this topic is almost aligned with the topic that we have finished. Like this monetary policy, almost aligned. So it will be quite easy for you to get this topic. Except, but yeah, one thing is this: in this topic, you will find lots of facts also for the examination, right? Though again, just like CR etc. that we have studied yesterday, that to understand the fact, you need to understand the concept well. But for examination, fact will be important, right? Rather than concept. But if you don't understand the concept, then you will forget the fact in the examination also. That is the one thing. Few concept will also be asked, but some facts are also there. That's the one thing. Second is quite relatable to the previous topic. So almost 50% you will be getting. Only some terminologies will keep coming, and that we need to refine. Well, so in the monetary policy, what we have learned that look, there are two sides of it. One side, the RBI and their policies, and then the economy, right? Even under RBI, we talked about OM, open market operation, right? So look, in the economy, those clients of RBI, like either you can say government, bank, NBFCs, etc., they are the clients of the RBI. In the NBFC, there are several corporations, could also be, right? So if they are lacking fund, where they are going to take money from the RBI, right? It means if State Bank of India need money, SBI will go to the RBI, right? PNB will go to the RBI. Because that is what we have studied. What if SBI, look, and what were the tools they had? Obviously, repo rate was the major tool that we have studied. On repo rate, at present, repo rate is 5.25%. That's the one thing. Second, on repo rate, they need to give collateral also. Is that it? Collateral has to be given, yes or no? Now think about it, that this State Bank of India need money, they want someone to give them the money, but they are lacking two things. Either they don't want to give this much interest, that's the first thing, right? Because 5.25 is a very high interest rate. You need to understand, 5.25 is not a less interest rate, it's a very high interest rate, right, in general. Then SBI do not want to give 5.25 interest rate, that's at first. And second, they also do not want to deposit the government security, right? In probability, because they think that look, this government security, if I deposit there, then my uses of this government security will not be good. So they are also lacking. What options State Bank of India has? That's the thing, right? No, because if they don't go there, what we have studied is a lender of last resort, because they are lacking money, they need money, they will approach the RBI to get the money. But if they don't, then what options they have? What they can do, right? Because they cannot ask the depositors, the saving bank depositor, no, you save more. They can only appeal, right? No, what options they have? There comes financial market. In this market, the financial market simply means that there, other than the RBI is also there. Repo rate will be there as well, right? This treasury bill will be the part of the financial market as well. But apart from that, there will be several other tools to those organizations to raise money, right? Also to sell it if they want to buy it or sell it. There will be two party all the time. Remember, in financial market, 3-4 things you always need to keep in mind. There will be two sides. One side will be the borrower, another side will be the lender, right? So there will always be two sides. One who will be borrowing, one who will be lending. And obviously, who is borrowing? Who is needing money? They are lacking money, they are borrowing. And those who have surplus money, they will lend. So that's the one thing you need to keep in mind, that who borrow. Suppose when we study commercial paper, certificate of deposit. So we are going to study that. In that, you need to keep in mind that who is issuing it, who are the one who issue the certificate of deposit, and who are the one who is buying it. That is important to understand it. So one thing you will be keeping in mind, that is the incoming slides, that who is borrower, who is lender. Second, what will be the interest rate, right? Interest rate, because look, under repo, that we have learned is fixed by RBI, right? But then this interest rate will be fixed here also, right? If yes, then who will be fixing that interest rate? Because repo, if you are going to the RBI is autonomous body, they are the regulatory body, they are fixing it. But if SBI is taking loan from other organizations, then who is deciding the interest rate? That is another thing that you need to keep in mind. And then obviously, what will be the impact on the economy? So these things that you need to understand. Now, coming to this financial market. So when we have understood that look, RBI is not the only organization, what could be the other organization? They are there. What could be if I guess you suppose okay, I was earlier asking the question, if SBI needs money, they are not going to the RBI, what are the options they have? So they can even take money from the PNB. They can even take money from the Allahabad Bank, right? Or Indian Bank. Allahabad Bank is not, no, they are merged with the Indian Bank. So suppose Indian Bank, they can take money from them. PNB needs money, PNB can take from SBI. PNB can take from the ICICI, right? Whoever has surplus money, they will take it. Because in the financial market, there may be some organization who has surplus money, as I told you, one will be the lender, and one is the borrower who has lacking money. So they can approach to anyone, right? So one side will be lender, another side will be borrowers. Lender will be the one who has surplus money. Now the second question I told you that you always keep in mind interest rate. Who will be deciding the interest rate? So suppose if State Bank of India is going for the PNB, now to the PNB to take the loan, right? What will be the interest rate then? And you people can tell me that who will decide? Because PNB is giving the money, you can say PNB will be decided factor here, right? Because PNB is the one who is lending it, right? But then remember one thing, that SBI, if PNB is saying that I will take, say it that the 5%, repo rate is 5, because they cannot ask more than repo rate. Because if they ask it, then they will go to the repo rate. So that's the common sense, right? So they cannot charge more than repo rate. That's for sure. So say they will say I'll charge you 5%. It's a little less than the repo rate. But remember, then SBI can go to the SDFC also, isn't it? They have, its entire financial market is there. Then they can approach others also. And if PNB has lot more fund, right, then they also want SBI to be there. Also, they want to continue the relationship that if SBI will be needing money, they will always approach me. So obviously, in the financial market, they will build relation as well, right? It means what? The interest rate will be market determined. Market determined means in this market, it's not only PNB. There is SDFC, ICICI. Apart from financial bank, there are corporations also. Bank can take loan from the corporate as well. They can take the loan. So corporate are also there. Now, if in the market there are less money available, right, then the interest rate will be higher. And if there will be more money available, then the interest rate will be lower. That is the meaning of market determined interest rate. If they ask you who decide interest rate, here the market decide interest rate. As simple as that. There is no authority. There is no fixed interest rate in this financial market, right? It depends that what is the situation of this. Who will decide it? Obviously. Then third question you need to keep in mind is collateral required, right? That we'll see the different tools for that. In almost all cases, collateral does not require. Almost all. Sometimes that is called secured, unsecured. We'll come to that, right? Almost no collateral required. That works on a trust basis itself, right? In almost every case. But yes, there could be some tools where they'll ask, no, I'll take some collateral, right? So these basic fundamentals are there. This is financial market. I have already both secured and unsecured means that only. It can be secured, but it can be unsecured, and mostly it is unsecured, right? Mostly unsecured market are there, and those who has the money, they will be lending it. Coming to this, some fact, as I told you, always keep fact in mind. Who regulate this market? RBI, right? Money market, especially money market came directly. I think earlier it was their financial market. Then money market will come little later. I thought, okay, why it moved. So what is the basic of financial market? I've already explained it to you. Who are the participant in this? I've already told you the RBI is still there, means government of India is there, the bank is there, NBFC, even individual can be there now. Yesterday I told you that under retail director scheme, even individual can participate. So you can also be there, right? And the big businesses, corporates, they are also there. Who are the participants? So fundamentals of financial market. What is this market? I hope you got it, right? Means those who is lacking money, those who have surplus money, they interact, and then the money flow comes here. This financial market is of mainly two types, but others also will see. One is this money market and capital market. These two are the dominant one, but obviously this will come little later after understanding the BOP. We'll study there. So, but these two also will study here itself. So these two are the major one: money market, capital market. Then there are some derivative market. What is derivative? We'll understand it today itself. What is commodity market? That we'll understand it today itself. These two are main. The number one is the money market. Can you people now guess it? What is money market? Look, one thing to understand here is that when you are buying something or selling something, you are giving money to someone. It could be either shorter period or longer period, right? Like under repo or under government security already we have seen it. That treasury bill, cash management bill is for the shorter period, less than 1 year, right? And for more than 1 year, we have dated security. In that, state government also participate, the central government also participate. Similarly, the two market for the, you can say, somehow better functioning of the market, government has organized in the money market and capital market, right? So functioning would be better, right? That you set in a long-term goal, short-term goal, so like that. The money market is the short-term market, where the short-term money transaction takes place. Short-term means maximum 1 year, right? Maximum will be 1 year. That is, exception are there. There is only one exception. We'll talk about it. But if they ask you in a definition that what is money market, then it will be the short-term money transaction takes place, and that is up to 1 year. It could be even one night as well. It starts from overnight and go up to 1 year. That is the first thing to understand, right? Short-term. And here, meaning of short-term is, start from overnight to 1 year. That is the meaning, right? Means it can be just 1 day and then up to 1 year. Yeah, quickly converted to cash. Obviously, when it means that the bond, securities, that is the what can be converted into cash. That we are going to study. It can be secured, unsecured. I have already told you this. I hope you are getting it. Wherever you get stuck, you can ask me. Primary objective is that who regulate money market. This is a fact you need to understand. Because capital market, when you study that, capital market is not only regulated by RBI. There are other entity will come under capital market like SEBI, Finance Ministry, as well as RBI. RBI will also be there. So capital market is not regulated by only one entity, but money market is regulated by RBI only. So that also you need to keep in mind. Some facts. Now coming to the tools of money market and what are the instruments, right? Why you people did not fix this issue earlier? All right. So look, there are three general, not only three, major three here we have taken. After that, we'll extend. So gradually we'll go further. The call money note. How you can remember this in your mind if that's coming. The call notice entered. Suppose that if I call you and ask you come right now, right? That is kind of calling. So it means it is overnight market. So call money, when you say it is overnight, right? Then the notice is kind of, now if I tell you, okay, finish this in 15 days. So that you can remember in that you are giving notice. That is 2 to 14 days that goes. And then 15 days to 1 year, that is called term money, right? The call money means of overnight. Call money, what is the meaning of call money? It is also called call money market. Call money market means that where transaction takes place for overnight only. That is the meaning of call money market. Whatever transaction that is taking places, that is for just one night. That is call money market, right? Look, who is the participant in this? Have I taken that on PPT or not? Otherwise, I will have to write some on the board if I have not taken it. No? Okay, fine. Then I will tell you something here only. Right. Look, first I told you already call money market. Though in the handout that I will give you, in that there will be written content, right? But here also, it is the overnight market that it is written only for the overnight. Remember, who is the participant in these markets? Right? Who can participate in the call? Participate means, as I told you earlier, you need to remember who is the borrower, who is the lender, right? That is important to understand. So in these market, especially in call money market, the borrower and lender both are banks and primary dealer, and mainly banks. Primary dealer are only few. I have already told you who is primary dealer. Primary dealer who is authorized by RBI. They can be anyone, right? But obviously RBI authorized very few, selective. So primary, but yeah, for examination purpose, if they ask you who can participate, the primary dealer will be there. But mainly bank participate. Participate in what? Participate in both borrowing and lending. Borrowing and lending, right? And other financial institution. When I say other financial institution, means other like all India financial institution. We have talked about NABARD, EXIM, Housing, National Housing Bank. These are the other financial institutions. If they are the participant, they can only lend, right? Not borrow. So other financial institution can only lend, not borrow. Means they will be giving money. So it's a fact only, right? You need to keep that fact in mind as well. The bank and primary dealers, they can both borrow and lend, but other financial institutions, mainly the all India financial institutions, they will only lend, not borrow. So this is one fact you need to remember. Now, look, in the call money market, right, how the interest rate will be decided? Just like I told you, it's a market determined. whatever, if there is too much demand, and then the interest rate will be high, right? If there are less demand, then interest rate will be low. Now you people tell me that the impact of it. Suppose if in the call money market, right? If in the call money market, interest rate is high, right? If you are getting it in the call money market, if interest rate is high, what does it indicate? What it indicates in the whole economy? What is the indication the government can note down, right? RBI. Okay. Greater demand. Anything else? Do you think if the interest rate is high, is the alarming situation? Yes or no? If it is there any alarming situation because of that? Inflation is high. If there is less money, then how inflation is high? But my question was that, look, my first understand the question. Everything that I am teaching you in the very first class till now, the back thing is needed to understand the next thing. Right? So, what I told you earlier that in the call who participate, there are several banks, SBI, HDFC, etc. Right? One is going there. How interest rate is determined? Determine that if there are more people is asking, less people is lending. That's why interest. So now question is, if in this market there are several participants, if the interest rate is higher, right? HDFC is telling that I will give you only at 5%, not below than that. You go to wherever you want. What does it indicate? It will not indicate inflation. Obviously, it simply means less money is there, right? That's why interest rate is high, because money is not there in their hand, right? Look, it's as you were saying about the money supply somehow. It means that in the entire market, because there is lacking money, right? Alarming situation is there. This is you can say first sign of a financial crisis. It is considered as the first time sign of a financial crisis. That why all of a sudden all banks do not have money. Think about it, right? Why SBI is going to HDFC and they are also going to PNB. PNB said I don't have money. They are also going to the other bank. So is this situation somehow giving indications a sign of financial crisis, that they are lacking money? All of a sudden, most of the bank. That's why interest rate is rising in the economy. It also indicates that suppose if a bank itself do not have money, they are going to the other bank. What if you are going to take the loan from the bank? No, you can just try to imagine it. SBI is going to take loan from the HDFC. You are going to take loan from the SBI. SBI itself do not have the money. That's why they are going there. No? So that is its indication. So whenever, if in the call money market, the interest rate is rising, RBI get alert and then right, yeah. Customers not to take loans. In the financial market, individuals are rarely going to buy this right now. Though individuals are there, but where individual can come, we are going to see the different tools right now. In that there are minimum amount is mentioned. Yeah. So it's not in participants among those government, RBI generally not banks, primary dealers, LICs, mutual funds. These all are the participants, right? They are the one. I hope you people got this, isn't it? Right? Anyways, this is conceptual thing I told you in between among all the fact that if it is rising, it's alarming. Obviously, it simply means lacking money they have. How interest rate is decided, I've already told you. That is the call money market. Notice money is obviously just remember the duration, right? Duration is 2 to 14 days. Term money is for 15 days to that. Now we'll look to the different tools of it. Major money market instruments, right? In that, we have already finished. We have already done the treasury bill. We have already done the cash management bill. We have already done the repo reverse repo. So there is no point in that. We are going to see this promissory note. Actually, these all are the types of promissory note itself. Right? Yeah, you have a question? Yes. Sorry. Yes. All. Yes. That is for all, right? But remember, okay, that also reminded me one thing. Remember that इसका remote भी होगा. There is remote of this. Remote. What is that remote? Okay, on this itself. Which is this one or this one? This one. Smaller one. This one. Bigger one. Okay, no issue. Leave that. Look, coming to this, in India, most of the transactions in money market that takes place in these two itself, and even in that, this is the most, the biggest use. Most, remember, right? Because as you can see that why they are approaching the other banks. They are lacking funds for their day-to-day activities, right? Money market main job is that only. Day-to-day activity means ki all of a sudden, suppose if there will be some, especially North India, even everywhere in the country, Holi is approaching, right? Now some festival season comes, New Year comes, Christmas party comes, right? All of a sudden, lots of people start withdrawing lots of money, right? So in that, what happens? That everybody has to do the party and all. So banks are day-to-day operation every day. You can easily assume it that the money that generally common people in overall India, they will be withdrawing today, and at the same time they will be withdrawing 31st night. Who do you think will be more withdrawal? Obviously, it is 31st night. So there could be some situations, some occasions, as festival seasons when people are withdrawing lots of money. So in day-to-day activity, bank might lack money, and then they approach the other banks to give the money, right? So that's why most transaction takes place in call money, and obviously some in the notice money if they want to keep a little bit more. In term money, there is very less under the money market. So these two are the mostly transacted in the country. Even in that, the top one, you can see this is the general trend, right? Generally, the maximum call money, then this one, and then this one. Under term money, that we are going to study this next. Yes.
Ultimately, the bank is taking to lend availability of money. The major criteria here. Ultimately, they are going to lend to the customers. So, while they are already whoever is giving the loan to the bank, they are charging higher interest rate. So obviously, these banks will charge higher interest rate for their customers. So that is discouraging the.
That will reduce the inflation actually. That will reduce the inflation. That is the first thing. But okay, I got you where you are waiting for. But why it do not generally impact inflation too much, right? Minor may be there, but why not? Because look, if you notice one thing, I think at that day I told you, one day I told you that always put almost every cases two scenario, entire economy in one side and government and RBI one side. If it is happening under treasury bill and all those, if that is happening, then that can impact, right? But what is happening in this is, even suppose if State Bank of India is taking money from the HDFC, for example, all right? So what is happening? Even if SBI do not take from the HDFC will be lending that itself if the bank money is there, right? When you study RBI is giving money to the bank, then in the entire economic banking system money has come. It is just transferring from one bank to other bank. Are you getting now? So almost money remains same. I did not take the class on M0, M1, M2, M3. If you people want, I can take it. I deliberately escaped it because in the last 10 years they have asked only one question, though that was a not difficult question. There was related to the what will happen to the money of the people if they withdraw from one pocket and putting there. That is one question. And those M0, M1 required minimum half an hour to finish because that's conceptual. If people want it, then I will give you that. But remember what happens when the money supply, that about the currency in the people, how this M0, M1 goes, M0, M1, M2, M3, and then the RBI. That currency, cash and currency with the public. That is one, what is called one column. Another column comes the bankers, the money that is deposited in the bank. Then money is in the hand of what is called RBI. So there are different columns. Then what is the money in the post office, right? So suppose if all bank comes at one place, right? So total money that is in the bank, that is at one place itself. They do not define how much in SBI, how much in HDFC. All banks are there. So suppose if HDFC is giving money to SBI, banking system money will be that much only. That is not changing. Yes. Yes. Yeah. Yeah, that is what I'm saying. That is what I'm saying. That in the economy itself, the money will be, right. Money is not going out of this, or not. Neither extra money is coming in this. In economy, suppose if HDFC is giving money to the SBI, no extra money came in the economy. Remember, right? In the economy, money remains same, right? Suppose if two are bank, you are giving to them, they are giving to you. Economy money supply did not increase with that. You can say that because people were withdrawing, SBI was not able to give, they will buy more. But ultimately, if they are not, you can use HDFC ATM also. In practical life, if you try to think it, right? No? You are not necessarily nowadays to withdraw money from the SBI itself. You can go to any of the ATM. You have to give some charges for that if you have already exhausted. So that hardly impact, right? So focus on that. You can say, as I told you, this treasury bill, cash management will also participate are there. So in that case, inflation could be affected a little bit, right? But there is a very minor effect on that. That's why we are escaping the part of inflation in this. All right. Okay. What I was telling you, these three we have already done. We'll be starting from this promissory note, and these all are types of promissory note itself. So what is this promissory note? Look, these terms, these are in day-to-day life, whatever we do, it is just like that only, right? Nothing changes. It's quite easy, but only the differences you need to keep in mind, right? What differentiates CD from CP? What differentiates bill of expense, exchange from banker acceptance? Only that. Otherwise, functioning will be almost similar. Minor differences will be further, and it is just like day-to-day functioning of life that it happens. So coming to the promissory note. Number one, suppose if I need some money from you, right? So what I will be promising to you, right? Because you will not give me money, randomly. So I'll write a paper. I'll write it down. You will ask me, okay, you write it down. You will give me on that day. You are taking me money today. After say it 1 year or 6 months. So suppose in this situation you write that after 6 months, right? The date is written. I'll be returning to you money. Suppose you are giving me 1 crore rupees. So I'll return that money. What will be interest rate you will charge? That will be returned to you. And I am promising you that I promise you to pay after this month. That is promissory note. As simple as that, right? And now in this case, that who is promising to whom? Right? If one bank is taking money from other bank, or one bank is taking from the corporate, right? Then those who is taking, they will be writing it that I promise to pay. So I might have that on this. Okay. Anyways, this looks like it. In the older days, again, just like government security, they used to do this physical promissory note. But nowadays, it's a dematerialized only, right? No, it's an online form. It is there. You just fill it, then that will be there. Just like it, as you can see, Mr. This one, I promised to. This is government actual one, right? No, on demand to pay the Imperial Bank. Imperial Bank, you remember, that became a State Bank of India, if you remember correctly, right? I did not go in the history because that is useless for UPSC now. Imperial Bank, how it become State Bank of India. So this is that the part how it is being written. Some things, all things that is written here, you will be getting it. But few things I'll explain on this. Look, when you say it is negotiable or non, it can be negotiable and non-negotiable. What does it mean? Now, negotiable means that suppose, as I told you earlier, you are giving me the money, right? And I have written on this. Suppose you have given 1 crore rupees. In that I have written after 6 months, the date will be there 6 months. I will pay you with 5% interest rate, right? And then return you the money. Now you cannot force me to return the money before 6 months, isn't it? Because if you are forcing me that no, you are not giving my money, I need this money, I have a dire need of etc. I will say no, but I am obliged, I am compelled to pay you after 6 months only. You can go to the court. Even court will not punish me that because the promise is for after 6 months. What if you required money in between? What option do you have, right? So what you hold in this case, you have given me the money, I have the money. What do you have? You have this piece of paper, guarantee paper, right? That I will be paying you after 6 months. In between, if you need money, you can give that paper to him, right? Okay, look, you keep that paper, you give me the money, right? And you will take the money after 6 months to this person. And because it is happening in the financial market, SBI, etc. is involved. If that is possible, if that is written on this, that is called negotiable. That is the meaning of negotiable, right? And that will be written, it is negotiable instrument or not. And if it is written, it is non-negotiable, then you cannot give to that person. I will not be giving money to him. Only we people will that. So that is the meaning. These promissory note can be negotiable or non-negotiable. All right. Well, legal instrument, fine. Obviously, it is legal instrument. Means it is just not randomly on the. It is called in economics over the counter. That also will study. It's not over the counter. It is a legal document. Means I am legally obliged to pay you. It's not just a simple sign. Payable to the bearer is illegal. What does it mean? Payable to the bearer is a kind of check. In the bearer check, that is also called. Suppose, I have given you this promissory note, and that you somehow missed somewhere, isn't it? Right? That can happen in life, and someone found it, and he will come to me. You give me that. That is not possible because when you are giving to other person, there will be agreement of this. You are giving to that. Now you will be considered to me. The payable to bearer means that whoever is bearing that, right? Anyone randomly take this and coming to this, that is not legal, right? The bearing will not be allowed. Parties involved, as simple as that, one will drawer, these just different names, drawer, debtor, maker, promiser, or all same, right? Drawer, and then the creditor, etc. Creditor is the one who is giving, right? Drawer is the one who is taking. So that is the meaning. Types of what could be different types. One is obviously on demand. On demand means, as I told you earlier, I have promised you after 6 months. But if in this promissory note, if it is written negotiable or non-negotiable, another thing is written on demand. It means there is no fixed date will be written 6 months. It is written that whenever you demand, I have to pay you, right? That will be written on it. That is called on demand promissory note. Usance means obviously a future date that is written, that is called usance promissory note, means that the 6 month, 1 year it will be written. Interest bearing means interest rate is written, or not interest free. Look, it could be interest free or it could be the discount on rate as well. Remember, we have studied the discounted rate, like treasury bill is the discount on face value. So it could be interest bearing, it could be the discount on face value, just like a treasury bill, as treasury bill is already the part of it, so is this discount. Or it could be non-interest bearing as well. If you think that you don't want to take interest from me, remember yesterday we were talking about tier 1 capital, tier 2 capital. I told you in tier 2 capital there could be some of them, so they are giving you money without, so that is the also interest free. It can be interest free, it can be date free as well, depending on that. So it is the how in this market. Earlier also I told you the trust is important in this. That is the different types of promissory note. Now 2, 3 only, there are 3, 4 I have taken the major one, and this is the only things happening. So obviously we will discuss that. Certificate of deposit, right? CT. Look, in this again, this is just for I have taken from the internet just to show you how it looks, though it doesn't matter. See the first line. Now you will be getting it quite easily because basic you have understood. It is negotiable money market instrument. What does it mean? It can be exchanged from one person to other person, right? Similar to the fixed deposit, but what fixed deposit similar means, look, as we have discussed, after 6 months I am obliged to pay you. Obviously I will be giving you after 6 months only, isn't it? So what happens in fixed deposit? That also, if 7 year, 5 year you do that, you get only after 7 year or 5 years. So it's a kind of similar is there, but fix, yeah, in a way you can say it's also like a fix. But difference is that fixed deposit not negotiable and tradable. I cannot take your fixed deposit money, right? So only bank will give it to me, right? So the same thing is, but it is fixed kind of. Dematerialized, that also I have told you, all is dematerialized only. Interest rate or discount on face value, that also I have told you. So now as I told you, if you understand one, everything will be similar, right? The interest rate, how interest rate is determined, that is market based. Same is here also, there is no fixed interest rate. Market based it will be there. Someone who is issuing it, if in the market there are less money available, interest rate will buy, less money available, regulated by RBI, right? Few more thing in this. That is the most important part will be there. Who is eligible to issue, right? Who can issue it and who cannot? Who can issue? Yeah, kind of. No, you can only do among yourself. You cannot look, even fixed deposit can be broken before maturity. If that can be broken. Number one, the thought is fixed deposit. Can you break it or not? You can. You have to give some penalty. You will not get the interest rate of the bank. Suppose you have the fixed deposit of 7 years in a bank. That is just a practical in the life. Suppose you have taken fixed deposit for 7 years, right? And some emergency came in your house. You want to withdraw the money in the 6 month itself. Bank will give you. Right, but yeah, one thing is that bank is not compelled to give you that moment itself. Bank can tell you, I'll take some time. Give me 2 days, give me 3 days, give me 5 days. Bank will take time because that is not demand liability first, it's time liability. They will give you. They might not give you the interest rate. Obviously, for 7 years or that is promised to you that you might not be getting. You will get the interest rate of that moment itself. Nowadays, even you can do it from mobile itself. Even fixed deposit, you can withdraw from mobile itself. And when you do that, they will show you that if you withdraw after this much money, you will get this much money. Why you are withdrawing? They'll keep asking you this. You can. Number one thing is that. But in what laws says that it is not the demand liability, so you cannot withdraw, right? That is the general. But cannot is that the options will be given here. The same thing is there. But difference is that fixed deposit is not negotiable. Nobody else can withdraw money on your behalf. In this case, they can. All right. Coming to the cities who can issue it and maturity period, right? Look, this certificate of deposit, as I told you, there are 4, 5 we have seen that we are going to do. This is one exception under maturity. So that we need to keep in mind. Rest will be there. Under maturity will come first. See this, and these 3 that you see is recently added, right? 1 year back itself. Earlier only banks were allowed under this, right? These banks. RRB and Small Finance Bank, last year itself they have RBI has added the name of the Small Finance Bank. Means earlier these Small Finance Bank and Regional Rural Bank were not allowed to issue the this CD, but now they can. So they can, and remember, selected all India financial institution I've already told you those NABARD, etc. But permitted by RBI. If they are permitted, there could be in financial institution, they have to take permit from the RBI to issue CD or not. If they want to issue it, then they need to take permit. Banks are generally already in a banking functioning itself, they are allowed to do that, right? So these are the one who can issue. Now the second question is that who they will be issuing means who can buy it, right? The one who is the issuer, one who is the buyer, right? So who can do that? All person resident in India. When you say all person resident means it could be individual, it could be the corporate, it could be the businesses, anyone. So that can be issued to anyone, right? Yeah, this is very important, you people. First, before I come to this, these facts, there are several facts. I told you in this class there will be facts a lot. Concept to understand, but for examination fact to remember. Is it clear to you what is CD, right? What is CD if I ask you what is CD? Why any equal need to issue CD? If they need money, it's a tradable instrument, they are needing money, so they are issuing it, that you take the money, I will give you the interest rate. It's as simple as that. For that, it's simple like a loan you are taking from the bank, and you sign an agreement. What happens in loan? They give you the loan, they charge you interest rate, you sign agreements. Just like that, just name are different, right? And some functioning are different, only like that. So CD is also that's a tradable instrument. They are, look, bank, what we have learned earlier, bank has asset. What is the asset of the bank? Loan is there. But bank cannot rely only on loan. A bank must have some other tools to function day-to-day operations, right? So these are the tools. That's why we have financial market separate. So who can issue, who to be issued, etc. I don't think there should be any problem. What do you understand by this line and why this rule are there? Okay, banks are not allowed to grant loan against CD. What is the meaning of it? Let me explain it to you. Though, if you remember the fact, that will do your job for examination. But still, I will tell you 1-2 lines so that it will be in mind. Suppose you, as first line is that anyone can take it, right? All residents from India, you can take it. And SBI can issue. So suppose SBI has issued this CD. This is CD. I have shown you the picture of CD fiscal form. Suppose you bought it. When SBI is giving it to you, and this is suppose that worth 5 crore, right? This is you. So what you got instead? You got one piece of paper. This you get, and what SBI will get instead? 5 crore rupees. So you have given 5 crore to SBI. SBI has given you this piece of paper, isn't it? That is how the CD means. Now suppose in between, and CG has a maturity date. You cannot ask SBI to give it to you. Now suppose you want a loan from ICICI for certain reasons. You need loan, isn't it? You might be needing loan, business loan, etc., etc. ICICI will tell you, how can I give you loan? 5 crore rupees, you give me some mortgages, collateral, right? Either the land paper and all. You say that, look, I have already given 5 crore rupees to the SBI and I have this paper, right? So that is itself is, as I told you earlier, negotiable, non-negotiable are there. So I have this 5 crore rupees worth, this CD paper. So you take my CD and you give me the loan, right? That they cannot do. That is the meaning. That is the meaning is that banks are not allowed to grant loan against CD. ICICI will not give this person loan against this CD. Are you getting? First you got it meaning around, then I'll ask you why. Everybody? Yes, no, you people seem confused, didn't get it? Okay, suppose that when you go to take loan from any of the bank, what banks ask you? They ask you collateral and jewelry, house paper, something land paper, you give them. Then only they'll give you a especially larger amount. They cannot give you, right? Isn't it? And suppose if you have some fixed deposit in the bank, then you can get a loan because you have already given bank the money earlier. So they will give you against fixed deposit, right? It happens now, that works as a collateral. Now see this story. How this CD comes to you? How do you get this CD? You have given money to someone, right? SBI has issued CD, you give by 5 crore to the SBI, SBI has given you CD. It means what? In a way you can say that in State Bank of India, CD 5 crore you have deposited and you have a certificate of that. No, you have a guarantee paper, yes, I have given 5 crore to the SBI. That is very good paper, right? Bank will trust you for that you have already given SBI. But you need loan. You want to take a loan from the other bank. So you are coming to the ICICI, ask him to give the loan. ICICI tell you what is mortgage that you are putting, right? Give me land paper. You say, no, I don't have land paper, but I have CD. So you take that. RBI instruct the bank not to do that. Not only instruct, only they, what is called, order them not to do that. It's a rule, right? That they cannot, they are not allowed. So ICICI will not give loan to this person against CD. They will give loan against land paper or whatever the ways that we have already studied how that is being done. But against CD they will not do that. This is the meaning. for example, if you just mug up, it will chew, but you got it. Now tell me why this rule are there. If you get it, why they are not allowed?
To prevent misuse of money.
Okay, how it misuses?
Secondary.
Okay, anybody else? Yeah, you were saying something. Anybody else? No, just think about it. Na, how banking, suppose, look, think about entire economy. There are several banks, right? So if CD are being issued, if sometimes even RBI can ask banks to issue CDs to take money from the people, they can ask them, right? So suppose one person has given 5 crore to SBI and he has withdrawn 5 crore from the ICICI. What is the money among the people? What are you getting? Money circulations in the economy that will get impacted. Overall banking system. Are you getting that? I have given SB to you 5 crore and I have taken 5 crore from him. I have still remained 5 crore in my pocket. Are you getting that? So overall banking system, what is happening in the company, that is somehow getting impacted. The overall process, the banking, functioning itself are getting impacted. So that is a particular thing. Yeah, if this person wants loan, they can take loan from other means. You take it, right? But just do not use only one thing. Suppose what, then otherwise if you don't do that, then it will this keep running. This ICI will take against CD from other, then against from the other, then that one CD is running everywhere. Think about it, isn't it, right? And they all are getting loan. And that was happening earlier, not the CD, but there recently RBI came with one new tool that you cannot have a multiple bank account in which you can take loan from that. You can have multiple bank account, but loan taking account will be only 2. Very recently, I think 5-6 months back that came. I don't find it relevant for your examination, that's why I'm not giving you. If you are preparing for RBI, etc., then it could be important. One very recently, one rules came that what businessmen were doing, they were doing that only. 10-15 account they were opening, right? And then they are taking loan from one bank, 2 bank, 3 bank. One bank is asking, return money, they are taking loan from other and then giving to others. They are asking, then they are taking from others, giving to others. Means they are not giving money from their pocket. So bank's money itself is circulating in the bank. That is entirely stopping the somehow not properly functioning of the bank is happening. So then RBI came that you can have maximum 2 account where you can withdraw the money, right? You can deposit money in as many banks as you want, but withdrawing can be only 2 banks, right? Major bank that you can choose any of them. That's up to you. So I hope this clears. Anyways, leave this white topic. I have to finish lots of things right now. We have to. I hope it is done, but remember the fact they are not allowed. Then what is the maturity? There is a huge difference. We have talked about that right now. Yeah, go ahead.
Same thing.
No, look, the first basic difference without getting the concept is that this is for less than 1 year, right? 1 year. No, you can, right? You can, but it's not mandatory. Suppose you are asking the differences, you have to write differences. Mostly FD are for the larger period. If you do FD for 1 year, there is no profit of doing that. Very minor profit you get. Mostly that is for the larger period. That's the one difference. Second is that, look, as earlier we have seen it, right? Like this promissory note, etc. They are not negotiable. In this case, here also it is not negotiable. This is negotiable only among bank. It is not negotiable. Now you can take money from others. Bank will not grant you loan, but you can give it to other person. That is allowed, right? So only bank will not give. It is negotiable. FD is not negotiable. So we have seen it. Right? There is huge difference. That is different thing. Don't mix it here and there. And secondly, there will be some similarities, right? Even look, when bank is taking loan from RBI, they are paying interest rate. Bank is taking from other bank. They are also. That is just different tools to have, right? So in the bank, what we have, I have also told you, the bank cannot rely on only one tool, taking loan from someone. You can say that why this much unnecessary jargon. You go to the repo rate, take the loan, everything is finished. But yeah, that is fine. You can do that. But there are different tools in the banking system, and that has to be. You cannot just rely on one, right? No. All right, okay. Maturity, some facts you need to remember. What is the maturity period for this? Look, as we have seen earlier, who can participate, right? The financial institution can also participate. Banks can obviously participate, right? For the bank, this maturity period is 7 to 1 year. It's not overnight. It means the minimum 7 days they can issue and maximum 1 year. But for the financial institution, the minimum 1 year and maximum 3 years, right? Are you getting this? And that's why I told you it is exceptional, because when it goes beyond 1, that somehow contradict with the definition of money market itself. What we have studied under money market, that it is short-term market up to 1 year, right? So this contradicts, isn't it? So this is exceptional case among all, and only allowed for the financial institution, not for others. RBI has given exception for this because of the different functioning style of these organizations. As we have discussed, generally why banks do that? Generally, they do when they are in the shortfall of day-to-day functioning, isn't it? All of a sudden, higher withdrawal that is happening in the banking system. That's where they do. But think about the financial institutions, NABARD, now Exim Bank, Housing Bank. There is no withdrawal happening every day. So whenever they borrow money, they generally have the requirement for the longer period, right? Whenever they issue CDs, etc., they require for the longer period. So if you ask them to return in the 7 days itself or 1 year itself, that will not justify their functioning. That's why RBI has made one exception. You can say that then they could have put it under capital market. Why they are putting under money market? Then when you will study under capital market, the things can go 30 year, 40 year also, right? Under the bond and say. So if that will again be the another exaggeration of that. If you are putting under capital market, that could be the very, very high long period. So that also, then where to put? Then they have to create another separate market. Are you getting? That will create unnecessary complexity. That's why they are here, right? So fact is that for the bank 7 days to 1 year, for financial institution 1 year to 3 years. Minimum 1, maximum 3. And minimum denomination is how much money you can withdraw. That is 5 lakh and multiple of after. Generally, it happens in the larger numbers, but minimum is there. There is no maximum limit of that, right? Done with the CD? Yeah. Look, first thing is that, see here, right? Who can issue? Who can take is there? Who can issue? So issue name is fixed. They cannot issue. Individual cannot issue itself. No. Okay. Look, resident under GDP will even today also probably if we will reach there under the balance of payment, we will study the meaning of resident. That will be little definition from the topic. But anyways, in one line I tell you what is the meaning of definition of resident in economy. In polity also we study resident and citizen difference in that. But in economy, residence means there are two major factors. One is that if you are living in your country, right? If all those people who is living in country, and in the foreign, if you are not living more than 1 year, right? If you are living more than 1 year in the foreign, then you become NRI. Remember that. Suppose if you are going to any tourist, do some tourism job, or even for some 1 year of the scholarship or 6 months of scholarship, you do not become NRI. You are still resident of country. That is how your income will be calculated in GDP when you study GDP. So residence means one. That is why I am defining the resident meaning. First, you understand the meaning of resident. Who are resident? Even foreigner can be resident of India if they are living here for more than 1 year, right? Now, then they become resident of India, but not the citizen of India. That's the thing. The definition of resident is that there are two major things. One is that who is resident. The basic thing you understand, those who is residing in your country means not outside your country for more than 1 year. So even if you suppose that you go there, other countries remain there for 9 months or 8 months, 6 months, you cannot call yourself I am NRI. You are still resident of India. But if you stay there for more than 1 year, then you become NRI, right? And same apply for other countries as well. GDP and GNP when we study, then we have this. So all person resident in India, not the citizens. It does not apply to the citizens. All right.
Sir, what is the difference between bank and finance?
Finance, look, bank is a type of financial institution. One type of, right? Bank is also a financial institution, but the type of, there are different types of financial institutions. Like we call in NBFC, non-banking financial companies. They are also financial companies itself, right? But their job is not just particularly banking facilities, depositing, lending money, etc. They do different things as well, right? They deal with that different things. So even LIC is the financial institution, right? But they don't do banking functioning. They are separate entities doing same things. So that is the thing. Means bank is one types of financial institution, right? It's not that bank is not financial. Bank is actually biggest financial institution in the country. But difference is that when you call it just all India financial institution, there could be simple financial institutions who is allowed, right? So that is the meaning. Done. Okay. Focus right now on your exam. Don't get deviated. That was UPSC teaches you, right? Do you know in the mains? Have you people written mains? Not yet. You will be writing this year for sure, right? You write that. Why there is a, you know what the, if you are really laborious, if you really work hard, what will be the most difficult thing in your examination? Do you know that? Most, because when I say you are working hard, if you are laborious, what does it mean? You have information for sure. Because if you are working hard, it means you will have information. The biggest challenge will be to construct your answer in the limited word. That is the biggest challenge, right? Because when you see the question, for example, budget will be studying. They have asked one question, and that was in the 10 marker only. Explain revenue budget and capital budget, and what are the component of it. Just this line looks very easy, but that is actually entire budget. Entire budget itself is divided into part: revenue budget and capital budget. How can you write in that 150 word, right? And you have to write. And then you find that I know entire budget, that I have taken 1 week of the class. But this is going to be challenge. And why they are asking you challenge? Because so that you can be, as I told you in the economics class, you will be rational. You only speak what is needed, right? What you do while writing, everything you see, that is the outcome of it. When you will be writing letter to the other department, right? Or you will be receiving letter, you will not write anything unnecessary. When you are talking, you are in the meeting, you are doing conference, you do not unnecessary things. Right, that you also allow me to not talk any unnecessary things. Okay, coming here, all right. So that's why focus right now. Be focused. Yeah, when we'll have a longer class, then I'll give you some. But right now I am somehow. Next is commercial paper, right? CP, that was CD. This is CP. Look, in this, though there are several eligible one who issue that, but majorly. You need to remember that this is mainly issued by the companies, means firms, private companies, mainly, not only. The list are here only itself who can. So if they ask you who can issue, obviously there are several issuers, right? But it is majorly issued by the private companies, firms. They are the one who is using it, right? Then apart from the companies who can do, so list is there, right? On the RBI website you can, the NBFCs, housing finance company, infrastructure. This was also the UPSC question, if you people remember it, 3-4 years back. InvITs and the REIT, the question they have asked. The question was not from this particular thing, from the different areas they have taken, that who can invest in this. That was the question type of, right? But anyways, this is the, they can also issue this. All India financial institution that we have already understood, they can issue. Anybody who is authorized by the RBI, who has given authority, but they need to have a minimum net worth of 100 crore, right? They can issue. And then any other entity permitted by RBI, you just understand, means who can, if RBI has given permission to any entity, they can issue, right? A specific name they have given also, but majorly it is companies that they are issuing. Functioning will be almost similar, nothing. Now, when you have seen who is eligible to invest, means who can buy, right? So issuer were there, now who is the borrowers? All residents, again, who are the residents, they are eligible to invest in that. Issued at a discounted rate and face value. Look, in this, they are a bit different than the first one. That can be issued as the face value as well as, means CD can be issued as face value as well as interest bearing, right? But this is issued at a discount to the face value, like a treasury bill characteristic. I hope you are getting the means. Discounted rate, it means that if they are issuing at the 1 lakh rupees, you pay at only 98,000, and while returning it you get 1 lakh. So that is the meaning of this. CP with option call put, we are going to study the meaning of that, so don't be hurried, because this is entirely different, right? What is option, what is call option, what is put option, we will study today itself. That is in the derivative market, right? Call derivative, put derivative, that we will study. This is again the very new RBI rule, right? Should not exceed 20%. Look, what does it mean by that? I have told you the company can issue it. Suppose you are the one who is individual, who is working in a company, right? Whoever you are, the MD or whoever of the member of that company. Your company is also issuing this. So if they have issued of 1 lakh or 1 crore worth, suppose for example 1 crore worth CP they have issued it, and you as an individual you want to participate in that, you cannot do that more than, means your investment cannot be more than 25%, right? If your company itself is investing 1 crore, you as an individual cannot invest 50 lakh. That should not exceed, means your investment can be only 25% if you are the part of that particular company. Why this rule is there? So that it will stable the share market and on the money market. Not the share market is not the part of it, money market. Because if you have some insider information that this company, then there could be different. That is the reason. Duration again 7 days to 1 year. That will be almost 1. And minimum denomination 5 lakh and multiple of 5 lakh, just like that. So these are the facts. That's it. All right. What is CP? Majorly by the companies, then the NBFCs, All India Financial Institution, and then any entity permitted by the RBI. Who is eligible to take it? All resident of India, right? It will be only at the discounted rate. That also, then remember the maturity. This is not that much important, but I have put it, right? The maturity is 7 to 1 year. There is no All India Financial Institution exception for this 3-year part in this. Remember that 1 to 3 only in the city, not under this, right? Even that All India Financial Institution. And then the minimum denomination is this one. All right. Commercial bill of exchange. This is very interesting. Look, first thing before I draw something to understand, I'll go to board to understand this. But remember one thing here, this is done. There are one thing here that establishes the goods and services buying and selling. Earlier, what was happening? CD and CP. One organization needs money. They are issuing a piece of paper, and you are giving the money. Are you getting? Suppose if I am the bank, I need money, and this is a piece of paper. I issue it. You give me the money. That's it. There is no goods you are selling. Right? No services that is being sold. Just one is the one who is lacking money, one who has surplus money. Fine. Here there is one difference, right? That the goods and services are getting involved. Something is being sold in this case. I'll explain it why. That's why it is called trade bill also. Trade that is happening. Let me give you the example that will make it easy to understand. Okay, suppose I'll take this one. Suppose that someone is selling something. What would you like to buy? Suppose you are a businessman. Nowadays, most of the IS, they are becoming businessmen. So, suppose if you want to do that, so seller or selling something, better write seller, right? So, someone who is the seller, they are selling something, and there will be buyer, isn't it? Who will be buying. So, buyer is the one. Say Mr. A, who is selling, and they are Mr. B, who is buying. So, this is B. Now, say it, for example, take it easy. Don't complicate things. Suppose this is the laptop, right? So you have the laptop business. So this seller is giving you the laptop. You will be buying it. Obviously, what you will give instead? Seller ko kya doge? What you will give? Money, right? But what if you don't have the money? You don't have money right now, right? Isn't it? Then, in generally in life, what happens? You say that I will give you after 3 months, isn't it? I will give you after 3 months. He agrees on that. He might charge you some interest rate. Suppose right now he is giving you at 1 lakh rupees only this laptop, but because you are giving him after 3 months, you will see that no, I will charge you 5%, and after 3 months, because you are giving me, so I will charge you 1.5, means 5% interest rate, right? That I will charge you. Is it fine? Yahan tak story clear is clear, right? Well, so now what he is writing? Now in this case, he will be writing it. There will be a paper on which this seller will be writing that I am giving you this laptop, right? That is worth 1 lakh rupees. You will be paying either the interest or discounted rate right now, whatever, that can be both. So talk interest rate, that will be easy to understand. You will be paying 5% interest rate, and after 3 months, right, you will give me the money. That he will be writing and keeping that. You sign on this, yes, I will be giving you. Is it fine? The story is clear? Well, this becomes trade bill or bill of exchange. That becomes. Okay? Then what is difference here? In this case, there will be one third party comes. What third party? Suppose if this seller required money in between. Are you getting? In between, he can require negotiable, we have learned it. If this seller required in between money, he will go to the bank. One bank, State Bank of India, and ask him, you keep this trade bill, right? After 1 month he is going there, you keep this bill, you take this money from this buyer, right, after 2 months, because 1 month has already passed, and you give me the money, right? SBI will say that, okay, I will give you the money, and he will keep this trade bill or bill of exchange. What is the benefit of SBI? Obviously, SBI will charge some fees and remaining interest. Remember, there are some interest attached with that. So, whatever interest of 1 month is there, that he will manage, but next 2 month interest SBI will be taking from this person. Are you getting? The benefit of SBI is the interest and some fees that they will charge. The story is clear till now? All of you? Right. There is one further thing will be added, and that while teaching you bank rate, I told you there is one more use of the bank rate. But here till this is clear now. So when he will be, SBI is giving the money and giving money to him and taking this money, that is called discounting the bill. The term is that. Why it is called discounting the bill? Because if this is of the 1 lakh worth, right, he might give 98,000 to him. Discount, or if interest rate is given, then he might give 1 lakh, but then take the interest. So discount is taking place. I hope a story is till now, there is no doubt, but then I'll go further. Now, what if SBI also needs money in between? That might be the case, right? SBI needs money. He can go to other bank but he can also go to the RBI. So I'm not removing the bank, otherwise it will keep running, the chain will keep running, that also requires that also. So come to directly at end. What if SBI also need money? SBI will go to the RBI and ask them, you take this bill and give me the money. RBI will take that, and that will be called rediscounting the bill. Rediscounting the bill, but there is one catch here. What rate RBI will rediscount? That will be called also bank rate. This is another definition of the bank rate. You will not find probably in any of the book that you have, right, this definition of bank rate. They just write the bank rate, the general definition that we have studied. When RBI bank need money for the longer period, they take that. And if you go deeper in the bank rate, every books are written differently. They are fighting among themselves. I told you who is eligible, only commercial bank. If you collect all 7-8 books, in some books even 2-3 you will find bank and private dealer also eligible. And then you say, sir, you told me that. That's why I'm telling you that there are some confusion among. But here you understood what is called this. This is also the rediscounting of the bill. That is called entire story of it, right? That I'll put it. But did you get this picture on? If you understand this, then you understand trade bill, right? What is difference in this case? That the one who is selling it, they are writing. Second thing is that there are third party involved in this. They are the banks who is promising to pay. And what is the major difference? Another difference from the CD and CP is that because here some goods or services is involved. Mostly goods, obviously, right? Now it can be services also, but generally goods. That was not involved in CD and CP. So there are goods involved. Something is being sold and buyer do not have the money, right? Earlier there was just two party. One has the lacking money and another has not. I hope it is clear, right? These things I have already written. Whatever I told you, this is written on that. So written things you can learn a little bit. Should I go to the next? Okay. Next is almost similar to this only, but with some difference. That is bankers' acceptance. Almost similar. Story remain almost same, but little change. And it is mostly, not only, but mostly it is done in the international exchange. International means export import. Something again you are buying something from the foreign country. Mostly it happens. But what makes it different from the earlier stories? That look, first let me take you back to the earlier. Though we have studied. What we have studied that there is a seller, right? And in this seller, I will draw it new one. The seller who, and then the buyer. This buyer do not have the money, and the seller, he said that I'll pay you after 3 months, right? And because this seller needs money, then he is going to the bank, isn't it? That's why we studied, he needs money in between. What if this seller do not need money, right, in between? Then the bank roll stopped here itself, isn't it? Means this chain can stop in these two, between these two. It does not necessarily has to go to the third party, right? Why he is going to the bank? Because he required money in between. That's why he's going there to the bank to give me, bank is charging fees, etc., etc. But if they ask you that, is it necessary that they will go to the bank? Obviously, the answer is no. Are you getting it now? Yes or no? No. Then how did you get the story first? Previous story. What we have studied? Okay, let me take. That's why I told you that this is the bill of exchange. Try to understand the story again. Don't worry, I'll give you because it's fine. No issue. Look, I'm explaining you trade bill. Previous one, not banker acceptance. Because if you don't understand trade bill, you will not understand this. So what we have understood under bill of exchange? One is the seller, one is the buyer. But buyer do not have money in the pocket. That generally happens. You people borrow something from the shopkeeper or not, I'll give you money tomorrow. That happens in day-to-day life. Okay, I'm going home right now, I don't have money, I'll give you tomorrow. They give us. It's a day-to-day life. And bankers are like us only, right? So they also do it. They are the buyer who is the buyer of some commodity. He is the businessman of this laptop, right? So he is buying something for seller, but he does not have cash or money. So money is not in his pocket, right? This is worth how much? Say it 1 crore. 1 lakh. I told you earlier 1 lakh. I will give the similar example. So that it. So this laptop was worth how much? 1 lakh. All right. What buyer promised? After how many months I will pay you back? 3 months. You keep getting engaged otherwise. 3 months. So seller can take money back after how many months? 3 months. But this seller required money, suppose after 1 month only. He might have some business, job itself. Because look, you have taken the laptop, but you have not given him the money. He need to make another laptop. He need money. So when he needs money, where he is going? Bank. And then bank is taking that bill. What bank will take that bill? But bank will give him the money. And then bank will collect that money from whom? From the buyer after 2 months, right? What I am trying to tell you in between, look, what if seller do not need money after 1 month? He have lots of money. Then is it necessary that he'll go to the bank? No. The flow will stop here only or not? It will stop now. If what I'm telling you, if he needs money in between, right, then only he's going to the bank. Now, what if he does not require money in between? So, because look, if he's going to the bank, he has to give some commission, right, some fees to the bank. Earlier he could have got 1,05,000. Now he's getting only 98,000. So there is a loss for him. But why is he still going? Because he has a very requirement of the money. That's why he's going now. So suppose that he can wait till 3 months, then he'll not go to the bank, right? So it might stop here. That is the meaning. What is the meaning is that in this bill of exchange or trade bill, this third party or fourth party or RBI is not necessarily included. It depends on the situation. If this seller required money, then he will go to the bank. If a bank required money in between, then he will go to the RBI, right? Otherwise, he will not go. Yes, means these two can settle this here itself. Yes, now it is clear to you all. It can settle, right? He will go there or not, but yes, it will still be called trade bill because there are two person who has signed it. So trade bill is there, bill of exchange is there, right? So that is there. But it will not go further until unless you don't need. You have given me the money now, you do not require in between. Then you will not ask me the money. No, give me. I told you that you will return me after 1 month, but I need money after 15 days. If you don't require, you don't go. As simple as that. Now I will come to the banker's acceptance. What makes it different? Again, there is a seller. All right, and again there is a buyer. The story exactly remains same. Again, buyer do not have the money, right? Seller has to sell something. But in this case, buyer tell the seller, look, I don't have the money, but you collect the money from my bank. This is my bank, State Bank of India. So instead of me, my bank will give you the money. Are you getting? My bank will give you the money. I will not give you the money, but my bank will give you. And I will give the bank after 3 months or 4 months, whatever the agreement, I will give the bank, right? Just like BJ Mala case yesterday I told you, right? So who you can take the money from? Bank. You take my money from bank, I will be writing, bank will give it to you, right? I will give money later on to the bank. Bank will charge obviously fees, right, for that. If suppose those same 1 lakh, what is called laptop might be costing him 1,02,000, 1,05,000. Did you get it? Now what it makes it different than the first one? That here they are necessarily involvement of third party, right? Because if he is saying that you take money from my bank and bank accept that, that's why it's named banker's acceptance. Name is the banker's acceptance. Bank accept, I will pay it to you, right? So that's why it's called banker's acceptance. Now you people tell me what makes it different than the trade bill. You tell me if you got it, all of you.
There is necessary involvement of
Third party, right? Necessary involvement. It has to be, otherwise, no. If they both can settle, then the third one, but there is a necessary involvement. 3 parties there. In the first, third party may come, may not come. Clear, all of you? Chalo. Now just remember, I told you that though they are concept, but facts. They will ask you facts only, but accept it. Everything that is required. Who are the party, third party, etc. Negotiable instrument, again that bank can go, that will further go like that. If that bank required money, they can go. That is negotiable. But the third party necessary are there. In the first, that's why I have written main part. In the earlier, I have not written, there are 3 parties are there, but it might end in the 2 party itself. But in this, the third party is necessary. All right. That was the money market instrument. Right. Before I come to the capital market, let's have a small revision of it, right? Let me take the board. You people do the quick revision of it. What are the major things we have discussed under the promissory types? One was the CD, means certificate of deposit. Then another was CP, commercial paper. Then obviously this trade bill and the bill of exchange, right? Bill of exchange, or this is also called trade bill, and banker's acceptance. These 4 are the major ones. Because rest we have already studied, repo, treasury, cash management bill, we have studied it already, right? So what are the major features of the certificate of deposit? Major features, certificate of deposit. It is negotiable, right? Who is the participants, means that who can issue? Yes, but for the FI, maturity is different, right? 1 to 3. For the that only less than 7 to 1, right? These are the major one to understand it. CP mainly issued by whom? Corporates, companies, mainly companies issued, but other can also participate, NBFC, etc. that we have issued it. Then in this, look, what another thing we have understood it, that participant all are the what is called resident, but in this all India financial institution do not have that luxury to take loan from 1 to 3 years. That is only under the CD, right? Mainly bill of exchange, that we have talked a lot right now. These two, so that's it. Now we'll be coming to the capital market. The basic thing is that the duration here, as the name is capital, it is for the longer period, right? Means 1 year and then go further, right? There is no fix, as it is above means it can be even higher than, sometimes it can be even go 30 or 40 years, depends, right? Even that much large it could be there. Even mostly, most instruments are generally more than 5 years and it goes 15 years, 20 years, depends, right? But while defining it, you will say that minimum 1 year and above, means 1 year and above, that is the instrument. Whatever instrument that is being issued, the minimum duration should be 1 year. What are the shares that we'll discuss in detail? All, not all, but these three, we'll discuss in detail. Share, debenture and bond. Who is regulating it? I told you already that it is not only by RBI. Money market is regulated by RBI, but there are three majorly SBI, sorry, SEBI. SEBI is regulating the most of it, as the share market will be regulated by the SEBI. But under this itself, there will be some instrument that is regulated by RBI also. There will be some instrument that is, for example, there will be mutual funds, etc. There will be some instrument that will be regulated by the two parties together. Some portions of it by SEBI, some portions of Finance Ministry. So if they ask you who regulate, kind of facts comes capital market, and the names are all three, then the answer will be all three, right? Not a single entity. So that fact also you need to keep in mind. Do not get confused with the finance minister, right? Or ministry of, not minister, Ministry of Finance, because it might occur in your mind, Ministry of Finance job is not to regulate, they are not a regulatory body, right? But it can be under certain circumstances. So that is also important. Primary market, secondary market. What is the difference? You people tell me, because this much you must have studied. Basic. What is basic difference between primary market and secondary? Tell me, you people tell me. What is difference between primary? This much, as you can, I think you people must be knowing it, right? What generally the difference between primary and secondary? Secondary market. Okay, yes. So who issued? It means that companies issue primary market, right? No. Yeah, true. That is means as is a primary market and secondary market, the basic difference is that only, right? Okay, look, suppose you want to buy the share of Google, right? Or the Apple, big companies, right? You will always want to buy, but what they are selling shares or not, that is also important. They are not, because everybody wants to buy the share of the Google. They can be, because they are the most profitable companies, Amazon, etc. So suppose that if a company, any company, say it Apple, right? Or in India you can name Reliance. If they are issuing its share, okay, share, what is share, that we will study just after this under instrument. And then if you can buy it directly, means it is issued by the company itself. The first issuance are taking place, right? Suppose I am that could be any company. If they are issuing the share and you are buying directly from the company, right? All right, thank you. Yeah. Oh yeah, actually your battery, I see that now. There is battery shutdown probably. All right. Well, so coming back, you people got 2-minute break also because of that. Coming to this, any company, if they are issuing directly, and your market simply means that something to buy, something to sell. So if a company directly selling and you are buying directly from the company, that market is called capital market. Sorry, the primary market. Name itself is primary, right? Now suppose you bought it, the share from the Apple, and you don't like that share, or you need money in between, right? Now, then you can sell the share to him, to her, etc. So you are doing among yourself. That is secondary market. So in the secondary market, people are buying and selling among themselves, right? Those who are the participant, and in primary market they are directly buying from the company. Basic difference is that. Now we will see the instruments of the primary market and the secondary market sale. The number one is the share. Look, do you know this year 2025 they have asked I think 3 questions from it. 2 was for sure, one will be solving, 1 or 2 will be solving in the classroom. One was the mix up, and the questions was how they picked the question, how they made the question. 3 options they have taken from the 3 different topics. So that is the one thing. Means that is why I have not taken that question yet, because that is the amalgamation of 2-3 topics together. One option is from the different topic, another option is from different topic, and then they make a one question right now. So, and though there is a relation little bit, but still the questions are different. So they have taken 2-3 questions. Let's see. And though this this financial market external sector has been evergreen, that we have already seen it, but this year they have asked from some area. But yes, they have not touched. They have asked from there here also. They have asked from here also, right? And they have mixed these two in together. They have not asked this one. They have not asked this one. So probably they might ask from this as well. So we'll see that the share and bond. They have mixed it and they have asked it. We'll solve that question. I have probably taken that question. Coming to this, but remember one thing, not necessarily they have asked, they will not ask again. They might ask different things about the share. Right? Coming to the share. What is this share? What do you understand by meaning share? What you have to define share in one line, what will you say? Say it. It is ownership capital, isn't it? It is ownership. Ownership simply means that when you buy share, you become owner of that company, isn't it? Right? Even 1% share, 0.5% share, whatever you have it, you become owner of that. So share means ownership, right? You become owner after buying that share. So when you become owner, obviously, your fate depend on the company's profit and the loss, isn't it? As simple as that, because you owner. Then you tell me. One thing is clear now, honor, what is the meaning of becoming owner? By share, you become part of the company. If company is making profit, you will be getting profit. Company is making loss, you will get the loss. But how you buy the share? Obviously by giving money, isn't it? When you give money, then only you buy. Buying simply means that. Now the question is this, will you get that money returned ever? Yes or no? Means, can the money that you have given company to buy the share, you do not enjoy that, you ask them, return my money. Is company liable to return that money? Answer is no. It is not returnable. That is why the line in share market is because in share market, once you put the money, if you make profit, that's fine. You can say that I can sell that share. That's different. You sell it, but you cannot ask company to return. You can where you can sell it in the secondary market that we have already. You can sell the share in the secondary market. If that share is still attractable to the people, they will buy it. If someone is not buying, they will not buy it, right? But you cannot ask company to return. It means it is non-returnable, right? You cannot. It is not returnable. All right. Well, suppose that the company share you bought it, that share is not giving you this much profit, right? And they are not returning you money either. Not returning means not returning cash. Like they are not returning you the money either. Can you ask them to give some interest also? Yeah, give me some interest, man. Right? You have taken by crores of rupees. They'll give you. Answer is obviously no. There is no interest paid on that because it is not interest instrument. It is the profit loss related. So there is no interest as well. There is no interest, right? You don't get any interest in that. So when you give capital, you become owner. That simply means when you become owner, you have to bear the profit and the loss of the company. Now, this much I think should be clear to you. Now the thing is, look, when I told you, you will become owner, you bought 1% share in Reliance, for example. 1% is the big percentage. So I'm taking you, suppose you bought 1% share, right? Most of this Shark Tank that you see, they don't have the 1% share in their own company. Do you know it or not? Mostly what happens when you make a company, time comes because to grow the company, you have to take money from others. When they are giving you the money, they are buying shares of your company. So they become larger shareholders. Even all big company you name, especially in India, right now. Exceptions are there. Facebook are the exceptions. We'll talk about that. Facebook, and he is criticized. Mark Zuckerberg is criticized for that also. But because of the ownership he want to hold, voting right? I'll be studying about why I'm giving you this. Suppose, you know, Flipkart under FDI will be studying tomorrow in that example. So suppose that if your share becomes so less, right now, that you yourself as owner of the company, your share becomes 0.1% and all that. Do you think that you can dictate the terms over there? No. Suppose if you bought 1% share, you are becoming the owner of the company. Can you ask the Reliance, look, the price of your internet charge is very high. You reduce this price. Can you ask it? What do I mean by that? That can you make rules and regulations over there? Can you do that? Answer is no, right? So here shareholders, those who is holding the share, they are the owner of that. They are called shareholders. But that is defined, or that is divided into two types, in major two types. One is that is called equity shareholders, right? And another is preferential shareholder. Preferential shareholder, equity shareholder and preferential shareholder. Who are equity shareholders? The equity shareholders has the voting rights, right? They have voting rights. It means they are the major shareholders in the company. They can decide that which product need to be launched, which product need not to be launched, etc. They are the major one. You know, when I have given you the example of that, Facebook, the Mark Zuckerberg holds the maximum share right now. So even if alone he want to dictate the rules, he can. Right? Suppose if there are 3-4 big shareholders, everybody has 10-12%, then obviously one person cannot dictate, right? But if you are holding more than 51% share, obviously you can, right? So the Mark Zuckerberg has, even from the initial itself, from initial time itself, when he built this company, when he was in the Harvard, when he was studying all those things, he from the beginning itself, his mind was like that how the company I will be running, right? And someone say not correctly or not correctly, right? That even some of the friends who helped him actually to build this in his engineering time, he kicked him out itself. They tried to show in social network movie also a little bit right now. So point is, he from the beginning he was like that. But anyways, sometimes it helped also. As you can see, this 2-3 recent example. FDI will is under FDI. I'll give you this example. But Sachin Bansal brothers, who has founded this FDI, he himself is kicked out from the company. Now he's not the owner of FDI. He's just doing something else. This Asnin Grover, right? Who what Bharat Pay, right? Now he's kicked out from his own company itself. So it might happen as well. If you obviously something that you built it like your children. Coming to this equity and shareholder, preferential shareholder, they have the voting rights. They are the major shareholders, and preferential shareholders are the one who do not have any voting rights. Right? They are the smaller shareholders. They don't have voting rights. They do not dictate terms of this. But now, tell me one thing. This is though basics. Because in your examination they try to twist questions like this also. They have asked this year. They have asked about the bond though. But suppose if a company, right, are somehow there is slowdown in the company, or the profit they are not making, right? They either try to close the company, try to sell the company, or they do that. They generally, right now, Unacademy is much in news. You might have seen it. They are trying to sell it. Nobody is buying it, right? In Delhi, students are on the strike. Have you seen it in Delhi center? There is a news. That is very bad, right? That is very bad. You do whatever you want with the company. At least do not play with the students. The students right now, today also, last 3 days, they are sitting on in the Karol Bagh near metro, but because their number is less right now in the centers, they are protesting that they have promised me this, that, etc., etc. They are not doing and all. They are. So this is happening with the Unacademy. They try to sell it, but not. But suppose if they sell this in Unacademy, they are trying to sell it. Leave the company name, talk about ABC, and these classes are being recorded. But suppose ABC Limited, right? They try to sell this company because if you people put their unnecessary, look, there is one thing that you people need to understand. He is one of my friend who is teaching in the Bachelor of History right now. He's a history teacher. When the protest was going on last 2 years back after death of the 2 students, obviously the teacher wanted to speak. They tried to do indirectly helpfully. What he said, that was a really good thing that I support his line. What he said that, look, I cannot bite the hand that feed me. Right? That's the thing. So that happens. Even if you become IS, IPS, you know that your persons are corrupt, but you try to save your department as well. So that's a kind of responsibility you feel towards. You can say it is unethical. We have studied in ethics. So ethics is the paper people learn how to write. they don't. That's the only thing that they are smart. They learn, and that's why ethics has become the most scoring paper. They know what to write. Ethics was actually introduced because of that only. Remember, because they saw. Look, any examination is the process of selecting, right? So UPSC examination was the process of selecting the creamy and the honest one, but ultimately they become lots of. So there is some flaw in the selection process. They introduce ethics paper. Anyways, leave that. Coming here. Why all things I started telling you? Suppose if some company is being sold, or the company position is really bad. Now, if they are actually selling the company, then after selling they will get some money, right? Then that money will be distributed among the shareholders. So who will get the money first? Those who is the big shareholders, owners, equity shareholder. Answer is no. The name itself is preferential. That's why they call preferential. Just like in army, right? When the bullet will be killed, you will be, the leader will be up front, right? The major will be there. You cannot send your subordinate there. So like that, because you are the owner and all, you will first distribute the benefit of that to the preferential, smaller shareholders, and you take later on. So that's why actually it is called preferential shareholder. All right. This is enough. Have I taken that or not? Even I don't remember about this. No. Okay, leave it. I have not taken nothing about these things. So coming to the debenture. Okay. Share is done. I hope so. What is debenture? Look, debenture is and the debenture is bond is almost similar, little bit similarity you can say. When we will coming to the bond, we will study in detail because bond is required some more emphasis. Debenture and share does not require that much. What is debenture? It is just like all those things we have studied, CD, etc. Only the duration will be different. In this, suppose if this is a company ABC Limited, right? This is a company, and this is you as an individual. It can be individual, it can be other companies also, but say to you as an individual, you want to invest in this company. You think that this company is very profitable, right? And they are making lots of profit, etc. You want to invest, but you do not want to participate in the share market because you think that sometimes if it get profit, you will get money. Sometimes not, you may not get money. So you invest in this company, but you invest some money. You give just like you give credit to them, loan to them, right? So suppose you give 1 crore rupees to this company, all right, and then the company will give you one piece of paper and you have given it. So you become debenture holder, right? So you are giving 1 crore. What you will get instead? What you get? Interest. You get interest. Whatever interest will be promised to you. For example, if they are promising 5 crore, 5%, you will get 5% interest on that, right? So this, what is the meaning of debenture? Debenture simply means that the debenture holder are the one who is the creditor to the company, who is giving credit to the company, right? And then what they get instead? They get interest rate. So now if I ask you that the money that is given by this debenture holder to the company, is it returnable or not? Yes, because it is just a money they are giving. So it is returnable. They will get any interest on that or not? Obviously, because that's why they are giving it. So they will get interest, right? What is less risky than share and debenture? Obviously, debenture is less risky, but which has the chance of less risky, which has the chance of getting more profit? Obviously the share, because in this you are safe side, so playing safe, obviously you'll have a less profit. That's it. Now coming to the bond. What is bond? If you people can say something about what do you understand by bond? Look, everything that we have studied. Look, government security we have studied it, right? Now, treasury bill, cash management bill, dated security we have studied, right? Dated security also called estate development loan, right? That is kind of bond itself. The bond, all the story that we have studied till now, related to the government security, related to the commercial paper, etc. It is kind of piece of paper, right? There are two companies, A and B, or individual. A needs money, right? What they will be issuing it? Bond. The name are different. Types of bond that will be issued. What A will be issuing? Bond. Because bond is just like a piece of paper, right? So they are issuing the bond, and B is buying bond. What B will be giving instead? Money, right? And there will be duration of that. So different types of bond. One can buy. That's the same story goes of the bond. So bond is how, if you have to define just like the definition of those, it is a tradable instrument. So what is bond? It's a tradable instrument in which the person or the companies who require money, they issue bond, right? And then what they get instead money, and the interest rate will be issued on that. One thing, should I tell you or not? But I think I should tell you that, because though that is something, one terminology is there that is called bond yield. Look, few things in the bond or even in the their term will be coupon rate. You people tell me, I have told you the meaning of this itself. What is the meaning of coupon rate? Interest rate. Coupon simply means interest. The term they use under bond is the coupon. What is the coupon rate? So whenever you see the coupon, that will be there. Second, yeah, that also reminded one thing because I have forgotten. Suppose the share you talked about earlier, right? Share earlier we have just talked about. On the share, whatever profit you get, that is called dividend, right? For example, with coupon we call it interest. No? On share, the profit that comes, that is called dividend. It means, right? Suppose you have bought a share of 100 rupees and you are getting 5 rupees profit of that. That profit is your dividend, right? So when you see this dividend word, it is nothing, just a profit on share. Right? No, nothing, just a different name. For share, you have put a different name, dividend on share. Similarly, on bond, whatever interest rate is given, that is coupon rate. So name should be a bit. For bond, we have another word also, right? That is called yield. What is the yield? Means profit again, right? In the share, you call it dividend. Here, you call bond yield. Right? Why I am taking this? There are inverse relationship between. I think I have taken that inverse relationship between bond yield and the bond price. That I will explain you a little bit. There is inverse relationship between bond yield and the bond price. This you need to understand by example. First, what is the meaning of bond yield? You people got it now. It is the profit on the bond, right? Should I take the board? How you people are writing? You people are getting these things. PPT. Yesterday you got it now. All entire PPT, everything. Why you don't approach to the sir? Because I shared to the Ashok sir right now. I have requested yesterday night also. You have not got any PPT yet from the first class till now. Now, I have shared everything that you are taking here. I think sir might have forgotten it right now. He might have slipped from his mind. Okay, you people have some groups etc. on this institution. So any of you request the Ashok sir. He has all the notes of this till now. Whatever classes I have taken, some 1-2 extra handout document I have given and on the PPT also. Because sometimes you can see there are lots of things are written on PPT, right? And if you start writing all those things, then I have to scan it like this, and then you will be writing. So it is the step. That's why what I do, everything on the PPT that I see. Okay, so that later on, if something you miss, that might happen. You are writing something that might you miss it. So please today you take it, right? That will be, and then what is called rectify your notes or mix your notes if you want to add something into that. Whatever note you have already made, something you might missed it. You should be doing it. Okay, I was coming to the bond. Look, before I come to the yield, yield means profit, fine. When it is profit, before I explain you the difference between these two, let me tell you 1-2 things. Suppose, just like share and the bond, right? If you are an individual and this is the company, ABC, right? You bought a bond from this company or you bought a share from this company. In the share, you become the talk about bond here, right? Suppose you are buying bond. Say this bond is worth 1 crore rupees. So who is issuing the bond? Company is issuing the bond. Why you are buying? You get interest on that, isn't it? So suppose that leave this 1 crore, say it is 100 crore bond. So you bought 100 crore bond. And they said that they will give you 5% interest on that. That's why you're buying it now. And remember it is more than 1 year, so obviously minimum 5% means 5 crore, so you will be getting, right? So you get 5 crore rupees. Earlier, how much money you had it? 100 crore. Now your total income become 105 crore because you will get 100 plus 5, isn't it? 105. So this 5 crore that you are getting, will you have to pay some tax on this 5 crore or not? Answer is yes. That you have to. The capital gain not. I will be talking about that, don't worry, right? So first is that because we will be studying the tax maybe in the last day because or tomorrow second half, right? We will be coming to fiscal policy. Let's see how quickly we go there. So look, first when you get here capital gain will be there when you will be setting. So leave the capital gain right now. Whatever income you are getting out of this, on that you have to pay income tax. Income tax slab. We will be studying how it is the slab right now. Up to 7 lakh is free. So more than 7 lakh if your income is there, then you have to pay the taxes, right? And then the slab are there, how much 20 lakh on 50 lakh, highest is the 30% you have to pay. So because this is on the highest slab, so on income tax slab you have to pay this, right? It means the first thing that we are studying here, understanding here, that on the bond, if your income is increasing on the bond price that get, you have to pay income tax according to the income tax slab. Right? Because you got 5 crore, it means you are on the highest slab, so 30%, Is it clear? It means income tax has to be. Second, that in between, if you are selling the bond here and there, right, you can do negotiable bonds, negotiable here. Then it is the capital gain, because you are transferring one capital to someone else and then you are buying something, right? Then the capital gain tax. It means in both cases, either you are selling among yourself and then you are getting capital. Suppose you bought a house, then you sell the house. So on that, you bought in 1 lakh, sell in 2 lakhs. So you have a capital gain on that, so you have to pay. We'll understand capital gain, not only, but you understand what point I want to tell you, that in the bond, the profit that you make, yield that you make, on that income tax has to be paid. Both can be kept. Now yield, when it is coming to you, the relationship between bond price, even look for your examination, if you remember this much only. If they ask you, what is relation, there is inverse relationship between bond yield and bond price, it will do your job. That should do. But what is the meaning of that? Do you want me to tell you, or I should go further? Leave that. Okay, then leave that, because I don't. You all are saying leave, so I am leaving it, right? But don't tell me later on that you did not explain. You just remember inverse. If the bond price is rising, the yield will be going low, right? If the bond price is going low, the yield will be getting higher. That as it is. So remember that price is high, yield is low. Price is low, yield is high. All right. This much you remember it. That will do your job. Now we will see different types of bond. Okay. Though the notes that I'll say today itself, in that I'll put one example. Okay. So even if you read that example, be sure of that. If I even in the I very less notes, because mostly I do the board work. Here I have to make these PPT, I engage it for you by waking in the night, right? So that you get it, and that things can be faster. Otherwise, suppose if I do everything on board, then I have to write everything on the board, and then you write from that. That takes almost half of the time. So that's why I thought give it here and then explain it. That is better. But in the notes, if I am putting it, then I put very easy language, so that even if you read later on after the class, when you forget something, you study different subject, still you should be able to catch that. So I try to make it easy. So I put the example in that. Coming to this, in this also we will study only 3-4, because rest is quite easy to understand. What is this? Look, types of bond means, see this first. Government bond simply means issued by the government. That is the government bond, right? No, state government issue, like dated security we studied. State development, no, that is the government bond. Even treasury bill, etc., will be kind of bond itself, kind of, not exactly. Government security is a government bond. State development loan, okay, written is also government bond. Public sector undertaking. Here, look, this is types of government bond, but if the PSU are issuing the bond, like this Coal India, the BSNL, they are the public sector units, if they are issuing the bond to raise money, that is public sector bond. Municipal bond, simply municipality are issuing it. Infrastructure bond means infrastructure companies are issuing, like Innovate and Artist that we have seen it, UPSC previous year question. They are issuing bond, then that is infrastructure bond, means related company. Corporate bond means corporate are issuing, any businesses, Reliance, etc., they are issuing the bond to raise money, that is corporate bond, right? From here we'll understand, this also I have explained it to you already, right? But still from here, these 4 will take. Zero coupon, inflation index, convertible and masala bond, right? So what is zero coupon bond? Though we have studied it already, but I want you people to tell me what is zero coupon bond, because we have studied 2-3 times. So zero coupon bond simply means that the bond will be issued at the least discounted value and redeemed at the face value. That's it. If it is 1 crore worth bond, it will be issued at the 98,000 or 97,000, whatever, and then later on when they will buy it back, they will get the 1 crore. That is the zero coupon. Zero coupon means zero interest bond. Few things more to be understood in this. Look, you people tell me that what could be the duration of the zero coupon bond. Means what? Yeah, go ahead. What could be the duration? How long? Look, suppose even if you don't know, right now fact you have not remembered, then use logics that you have studied till now. 2 logic you should use. Number 1, what we are studying? We are studying the, no, bond is, what is bond? Instrument of a capital market. Bond is the instrument of capital market. Capital market is more than 1 year. So obviously it has to be for the longer period. One thing that we have studied. We have also studied is the bond, as it is the zero coupon and the government bond under the money market can be less, like the, what is called treasury bill cash management, right? So when you call it bond, zero coupon bonds, this is mostly, not only, that is important, right? Because UPSC sometimes asks only and the mostly, almost you can say issued for the longer period, sometimes even 5 years to 40 years, right? But it can be, remember, can be issued at the lesser also. You can say again, then it is contradicting the capital market, but It can be similar like a financing market. All right, that is the one thing. Few examples, look now, of government examples I have given you because you need to remember this Kisan Vikas Patra and Bharat Sanchar Nigam Limited. These are the zero coupon bond itself. I have taken these two deliberately because if they put it in the examination schemes, they are putting it. This Kisan Vikas Patra and the Bharat Sanchar Nigam Limited bond are the zero coupon bond. Right? Mostly long period I told you, but can be issued as a shorter period also. All right. Should I go to the next? I will say it to you, don't worry about it. Inflation index bond. From here also already questions are there. Okay, if without looking at the board, when don't read it, you tell me what I taught you already about the indexation meaning. What is the meaning of index? Very good, right? So inflation index, or suppose if inflation will not be there, something else will be written. The index simply means adjusting, right? Here inflation adjust means adjusting inflation. It could be adjusting something else. Whenever you see the word indexed, it simply means it is being adjusted with something. I have to adjust this board first. Indexation means adjusting, right? Because look, at that day we have studied what was the word in this previous question? Indexation, wages, no, wage indexation. That was the under question we have solved. Wage indexation means that what? If the inflation is rising, your salary will be adjusted accordingly, right? So that is also adjusting the inflation, but wage is also accordingly getting adjusted. That is the inflation index bond. Now, what does it mean if you just go through the name? Suppose, look, what we have learned is suppose one side, anyone can issue the government, corporate, we have seen is corporate, municipality, infrastructure, they issue. Suppose it is government bond. For example, take government. So it is government, they are issuing the bond, right? This is the bond. And we people are buying it. All common people in this, they are buying it, right? So why government issue bond? Because they need money, right? And government promise you that I'll pay you certain interest. So say, suppose government promise you 5% interest, then you bought the bond. But now, if the inflation start rising, why you give the money to them so that you get some interest? Otherwise, 5% interest rate could be very less. 4% bank is giving to you, right? The fixed deposit is giving you 7%. Why you will give on 5%, right? No. So you will not give. It means you want little more. Especially if inflation will come, your interest will become less. So government tell you, okay, fine. This bond is not a normal bond. It is a special bond. It is adjusted with inflation. It means right now the 5% is there, but if inflation will rises by 1%, your interest will also rise by 1%. Right now your interest is 5%. If inflation will become 5 to 6, your interest will also become 6. Are you getting? That is inflation adjust. It means the interest that you get on it, that will be adjusted with inflation. If inflation is rising, your interest will also rise. Is it clear? If yes, then tell me the probability. I'm asking you, what could be the probability? There are two bonds that is being issued by the government. One is the normal bond, one is inflation index bond. And on both of the bond, government will be paying interest. On which you think that government can pay less interest? Inflation indexed, right? Because they are giving you another benefit with that. So on inflation index bond, probability are there, they will be giving you less interest. And probability why I am using that they can give you similar interest, but mostly they give less interest itself because they are giving you one benefit. Government also has to manage it, isn't it? Something they give you, something they will take, then only they will be in the benefit. So that is the meaning. Everything I have already written down. Look, this particular line is because if these are coming in the examination, then that confuses a student, right? Now, the government security, these bonds are eligible for SLR. What does it mean? Because that one type, I don't remember exactly in which year, but in less than 10 years itself, UPSC has asked these questions. They put something different word there just to confuse the students, right? Things are very normal, easy, but just to confuse, they put it. As you can see this line, that might sound confusing, right now. The government security, as a government security, these bonds are eligible for SLR. What does it mean?
Is equivalent to liquidity. And they can be used as reserves.
Yes. So that is actually UPSC question was once, right? They ask you that you buy the bond, right? This bond, can that bond be what is called put it under SLR or not? The answer is yes. That can. It is government security itself, and under SLR you have to put either cash, gold or government security. You put any government security, right? No, if the government security can be used or not. The answer is yes, right? If that falls under the criteria of government security, it is government security you can put. You can say it is a corporate bond, then answer will be not, because it is not issued by the government. If government is issuing any bond, that can you put it? Remember that, right? Any security, any government security that you can put under SLR. So when they suppose even if you don't know it, you can use, you should use, that is just put it to confuse you. And obviously you got confused. And that is what UPSC wants, to confuse you. When they say that the government, when we have learned under SLR you can put government security, is there any condition written that which types of government security? No, this is just government security. So any government bonds, and bonds are type of security, can be put it over there. So there is nothing brain jargon here. But in the examination it keeps coming, ye to nahi tha, this was not there. So that's why I have put it here, right? Even any means any, all other meaning. Less interest, I have already told you, that can be less interest. And obviously, look, they will pay you the less interest, but because it is inflation index bond, there is no special treatment. Special means that, no, we have talked about, no, on the bond, the income that you are getting, income tax you have to pay. In this also, whatever income you will be getting, interest in, you have to pay. There is no, because this is something different, then you don't have to pay. Convertible and non-convertible, that is the next thing, next types of bond. What is convertible bond, what is non-convertible? This you can link through the restructuring. We studied restructure yesterday, right? Restructure we have studied now under NPA. If they are not able to give, then what they do, they restructure it, right? If you don't have money, give me some share itself. Similarly, suppose if you have bought the bond of this company ABC, right? You bought the bond. So when you bought the bond of this, what you will be paying to them? Money, and then they will be giving you interest later on, right? This company you have given money, and after few years or whatever the date are there, company will be returning you interest plus principal amount. What if the company does not have the money to return you, right? Time has already come, etc. So if the bond you are buying, on that it is written, it is convertible bond. It will be written, whatever you are saying, that will be written, it is convertible, it is negotiable, etc. It will be written. If on that bond it is written, it is convertible bond, what does it mean? Later on you can convert this money into the shares, right? It means you can become the owner of that company. Company are not paying you the money, but because it is a convertible bond, then what you can do, that they will give you some share of your company instead of restructuring it. Suppose you are the company, I have given you money, after 6 months you are not returning it, but my bond is convertible. Then I will take some portions of your company, 2%, 5%, that will be agreed upon already, right? That is convertible, as simple as that. So convertible bond means can be converted into the shares, that is the convertible bond. And what is non-convertible? Obviously that cannot be converted, right? And on that, I hope it is making sense to you all, you understand. Now this convertible can be two types, easy to understand again, fully or partially, right? Means if on your bond it is written it is fully convertible, it means entire money can be converted to the shares. You have given 10 crore, you will take the whole 10 crore worth share of the company. But it will be written partially, means 25%, 50%, that will be mentioned. Remember, everything that can be done later on will be mentioned on the bond, right? So if it is partially convertible, it means only that portions, whatever is mentioned, can be converted. That is the partial convertible, right? Non-convertible simple means that it cannot be convertible at all. One thing you people tell me, that this you got it, convertible is easy to get. Look, is there any chance that if your bond is convertible, right? Convertible, not convertible, it can have some benefit in the inflation, coming inflation, right? If the inflation is taking place, can give you some kind of, some at least little bit help in the inflation. Not necessarily exactly, but can you get some help in this? Though it is not inflation indexed, that if inflation is increasing, your what is called interest rate will be adjusted there. That is not, that is inflation index bond. But if it is convertible, the chances are there or not, that is the point I'm asking. Chances are there. It can give you certain degree of indexation because there is no fixed rate in this, right? Isn't it? Fixed rate is not there, or because it can be converted. Suppose if company is growing well, right, and then it is convertible bond, you want to convert it, and then you get more profit because you become owner of that. In share you get fixed percentage, whatever, sorry, in bond you get fixed percentage, but now you are becoming owner, company is making better, and then your profit become higher, inflation rate is less, then it can. But remember, the word is it can, not necessarily it will, because if your company is even going down, you are converting it, the inflation will be higher, then it will be against as well. So it can be, and in probability, look, if you want to convert it, then most probably you will convert when you see the profit in that, right? Otherwise you will not convert it. So it can give you certain kind of indexation. If suppose if it is convertible bond, again the chances are there on which one there will be higher interest rate and lower. Where will be the higher interest rate, on non-convertible or convertible bond? Which probabilities I'm asking? UPSC asks all probabilities only. Where there could be the high interest rate charged. Look, non-convertible means you will get higher interest on this because there is no indexation later on. But in this, you might get lower interest rate because look, whenever you get extra benefit in economics, the first day we have studied trade-off, right? Whatever you do, instead you have to give something. You can never, nothing is free in the world. It is called. So if you are getting some benefit out of it, something you have to give from that. So because you got one benefit that you can convert, you can become owner also of that company. So what they might give you less interest rate, might. Again, why I am emphasis on these words, might, can, etc. Because this is not mandatory rule that it will be, right? But might be there. So this is the convertible one. All right, yes. हाँ बिग बाजार में हाँ तो वो necessarily bond के through नहीं था. Look, suppose as you studied earlier, no, you can invest in the companies right now, and even if it is not convertible, then later on you can make agreement of that. Now that's a simple thing. It not necessarily has to be right, but that was not the convertible bond issues. They have invested money into that, they were not able to pay, so they took over, right? But convertible bond was not there. In this bond, it's just a facility given to you. Okay. Well, coming to the next, masala bond. I think this is the last type of bond. First, why it is called masala? Because the truth is that only every country has this kind of bond. Whatever that country is famous for, they name that bond with that. India is famous for their spices. I did not know that in Hyderabad that much spice is being eaten, right? Every day I'm eating too spice. Yeah, really, I was earlier thinking that the North India eat lots of spices. But recently I got to know. In Delhi, the South Indian food are less spicy than here. I think they give less spice there. I earlier thought that that's why I prefer South Indian food in Delhi more than here. That was too spicy. But more tastier, that also I find. Like the idli and the coconut chutney, I never find that in Delhi. That good that is here. That's the truth. But anyways, that reminded me the spice. That is the name of this. That's why actually the name masala bond. This is very important. This is very good bond actually. Though UPSC has already asked this question, it's a very good facility given to the Indian bond issuers. In this, what they can do? Look, Indian companies, they can issue their bond in the foreign countries, right? And they can issue the bond in rupee. That is very important. That's why this makes very special this bond. This is a special bond. None of this that we have studied till was this much special. Look, suppose if you are taking money from foreign, right? Taking money from foreign. When you return the money, what you have to give them? Dollar. Suppose if you are taking dollar, you have to give dollar, right? That's a simple thing. But in this case, it is issued in rupee. Issued in rupee means that you are giving them the bond, they are giving you the money. So you are taking dollars, right? Or they, what is called, exchange it in the rupee, they'll give you the rupee, but you are taking that. When you return them, you will return in rupee only, right? It is their job to exchange it and convert it into the dollar. You will give them in rupee. Even the interest that you pay in rupee. Are you getting? So what is masala bond first? It is issued by the Indian companies in the foreign market, and it is a rupee denomination. So these two terms you remember first. Number one, it is issued by Indian companies in the foreign market and issued in the rupee denomination. When you call rupee denomination, means you take rupee, you give rupee, right? And you give interest also in rupee. If you got this two lines, then what is the benefit of it? Why it is so special? Benefit is that, as you have seen, the rupee depreciating, right? That will not impact India in that case, because this is fixed. They have taken rupee, they will give you rupee. If the rupee is depreciated at all, then they will face the problem, right? So it is the risk associated with the foreign companies. Is this clear? All three things. Then the question comes: if the risk is there and they see rupee is depreciating, then why they will invest? They will not buy Indian masala bond right now. They are not compelled to buy it now. Then how will get benefit out of it? India is famous to giving more interest rate than others, right? That's for sure. We don't be sure of that. In almost every cases, India pay higher interest rate than other countries, right? And even in banking, in the bank also, saving bank account, they are giving you 4%. Very rarely you find any developed country they give 4%. They in fact charge you. Sometimes they give you 1%, less than 1%. They don't give percent. But in India you get it. Even NRI accounts are there that India gives higher interest rate. Because India is paying higher interest rate, they are ready to take the risk, right? So that's why they invest, and this is very helpful. And obviously, there are some facts associated with the first masala bond was issued by the World Bank. From related to World Bank, this year again there was one question from IBRD related, right? Issued by this maturity period. I don't think that much important is there, but there are three different types of how much you will read it later on. $50 million, etc. So USD $50 million equivalent होना चाहिए. But leave that. You remember these 4 things: who issue it, how it is functioning, right, and what benefit India got. Issued by Indian companies in the foreign market and rupee denominated. How they benefit? They benefit because they don't have to follow the exchange rate problems, right? Why still they invest? They invest because we pay higher interest rate. That's it. Done. Any question you people have? We have, I think, done with the bond. Okay, no, there are one more thing. This is current news. That is happening till now. It started from 2024. The news came in 2024. It started happening in 2025. And because 2025 is 1 year, obviously, for your examination, so this is the current news, so we'll take that. Internationalization of the bond. This is not internationalization of the rupee. That we'll talk a little later, if time permits. Internationalization of the bond. Look, JP Morgan is a company, right? First started with the JP Morgan, then there are other companies also. As you can see, after JP Morgan, Bloomberg, FTSE Russell, they are including the Indian bond. These are all screenshot from the either Hindu, Indian Express, etc. What is this news about, right? What is this JP Morgan first? So first, let me tell you the news about, then you will understand. Look, JP Morgan is a US agency who deals with in this bond, right? Now, before I come to this technicality, suppose if you want to watch movie, any movies in general, that is say the South Korean movie or any movie from Iran, etc. That is not being shown in any of the theater there. What do you generally do? What do? You go to the OTT, right? Any OTTs, for example, take it, suppose, and which OTT you will prefer, suppose that you think, okay, no, it might not be available on JioStar or something. Who do you think that they have the maximum collection in general? Netflix, because internationally that could be. Suppose, for example, you choose Netflix. That is this story. If you get it, you get the joke. So you are choosing Netflix. Why you are choosing Netflix? Because it's the most trustworthy. Probably it has the widest network, right? Wider range of movies available, etc. So you might choose it. So this is about you who is choosing as a consumer, right? Also, someone who is a producer of these movies, they also need to choose which platform they will be putting their movies, isn't it? Now, someone might not put their movie. That happens already. They are selling it. They might choose the if someone is giving them more money. Suppose Jio will give them more money, then they might put on the Jio Hotstar. But the probability is there. They might not be showing in the other countries. Right? So the producer also need to choose that which platform is better for them. Right? So producer also might look for the Netflix rather than this Prime or Jio because they think the whole world will watch my movie, and then I'll get more and more money. Right? So everybody is choosing Netflix, producer as well as consumer. Right, because of the trustworthiness. JP Morgan is that kind of platform, you can say, where the bond is being bought or sold. So you can say JP Morgan you can replace with the Netflix. That is a platform where someone they want to buy the foreign bond. Suppose if someone from US they want to buy Indian bond, how they can buy, right? The point is that either they have to be listed in the Bombay Stock Exchange, right? Someone from the foreign US they want to buy. They first list themselves in the Bombay Stock Exchange or National Stock Exchange. So first they have to register there, right? Then become participant. Then they have to be eligibility. They need to follow. Then they will be able to buy it. So there is a lot more exercise. What if there is a platform they can list themselves there itself, and Indian bond is available there? Then they can easily buy. So that was not earlier the case. Means if India has to sell to the foreign investors, then they need to invest here in India, register here in India, in the Bombay Stock Exchange, etc. So now from last year itself, right, Indian bond, as you see this news, Indian bond is listed. JP Morgan first decided to do that. And because JP Morgan is most trustworthy, they see that, okay, Indian bond is here, other companies are also started coming, right? So this is the whole story. So this is internationalization of Indian bond, right? Did you get it? Now, if they might ask you that some facts is there, number, what is the meaning of internationalization of the bond? It means Indian bond is being listed in the foreign exchange rates, foreign stock market like JP Morgan. Who has given the first to permit? That is the JP Morgan. These are the facts. What is that? That also is studied. The third thing they might ask you that if Indian bond is listed in the this JP Morgan, etc., internationalization is taking place. What benefit we can get it? What benefit we will get out of it? No. If Indian bond is listed in JP Morgan, what benefit we'll get? We'll get more money, right? Diverse market will have it, right? And suppose, look, if lot of people, because now it was only in India, if Indian bond is listed there, lot of people will be asking, right? Then India might say, I'll pay you less interest rate, because Indian bond has several, what is called, customers. So when someone buying bond, you have to pay interest rate. That's why they will buy. Otherwise, why they will buy? They are giving you money. So now suppose Indian government need money, right? They have to put money into India itself, and nobody is buying it. Then government has to give some benefit. Now I'll give you 5%, 8%. Please buy. But now if there are several people who are actually willing to buy it, then Indian government will say, I will buy, give you less interest rate. So that will benefit India. They will save money, right? Also, that money can be diversified. Also, Indian banks will not be compelled to buy Indian government, because sometimes it happens, moral suasion, we have studied it. If government needs money, right, they want bank to buy the bond. Bank are not buying. What they will say? They will ask, please buy, because we need money, right? The bank will buy. Then bank funds get closed. All these benefits will be there. I have written these things. So benefits, all I have discussed it already. You know that, right? Because potentially lower countries sovereign borrowing cost is that means we have to pay less interest rate. That's why lower it. Health, finance, fiscal deficit, current account deficit we will study today itself, right? Free liquidity from the market, diversify funding sources, and foreign currency reserve. As you said earlier, foreign currency will come. All right. That's it. Okay, now solve a few questions before we come to that. 3-4 questions we'll solve. And let me see how many questions I have taken from these areas. Yeah, we have 4-5 questions. We'll solve that, then we proceed. Try to solve one by one. Try to eliminate. Okay, yeah, 4 is eliminated easily, isn't it? Zero coupon bond are interest bearing. It's not interest bearing. The name itself is zero coupon, so eliminate 4. We are left with 1 and 2, and 1 and 3 means 1 has to be correct. Commercial paper is short term, unsecured. Obviously, commercial paper, certificate, deposit, and call money, all are short term, right? So obviously, first is correct. What about 2 and 3? Certificate, deposit, long. Obviously, it is not long term. It's a quite easy one, right? So if commercial paper, then it is not. Second is not the 1 and 3. 3 is call money is a short term. It's an easy one to pick. All right. We go to the next. This is this year question, right? 2025. Okay. Last line I have not told you, but still you should be able to solve this. Yeah, still you can solve this. It's an easy one. Only one? Think well, man. Read it well and try to analyze it. Okay, yeah. A. Anybody else? Go through the statement. As regard return from an investment income, generally bondholders are considered to be relatively what? First statement is correct or not? Not relatively. They are obviously bond. I told you bond debenture are same. In the see this, bond stock means share itself. Share stock is same, right? Risk, where is more risk in the share stock? So first is correct or not? Yes, it is correct, because bond you give, there is no risk, almost no. Why I say almost? Because look, if the company become bankrupt, country itself become bankrupt, that is an extreme situation. In general, obviously you will get permanent return, that is fixed that you get return, as well as the principal amount. So there is no risk in the bond, right? But in share there is always risk, always. That's why high risk, high return. Bond, obviously there is no risk. It's that they are telling you relatively less, but obviously relative. So first is bondholder are lender to the company, stockholder are owner. Yes or no? Yes. There is no doubt about it. For the repayment person, bondholder are privatized over stockholder. Yes or no? Yes, because they have to give it. Look, that is also the language. But point is that suppose if they are selling complete sale, even if you put that logic, suppose if they do that, the bondholder, they are compelled to give it money, because otherwise they will go to the court. No, because they have given you money, right? No, they are creditor to you. So you have, otherwise they will go like, how can you take my money and go back? Your company has shut down. That is your problem. You solve your issues. How you borrow, how you pay. But it is my money I have given to you. You have to pay. You know, that's a general life. Someone has given you debt. They will take your money. You can say my company is down. I have issues. But if he is so strict that they want their money back, they will take your money back, right? So obviously there is bond holder are prioritized over stockholder, and we have studied these things right now, right? No, debenture and all. This is compulsory payment. I told you, no, where you get compulsory payment, returnable interest. Yes, all three are correct. And because look, obviously that is explaining the first. Na? If look, a stockholder are owner and bondholders are the lender of the company, so lender will get what is called lower interest but lower risk also. So that explain first, right? And because bondholder prioritize means lower risk, so that explain first. So obviously 2 and 3 are correct, and both of them explain first. Though I'll not tell you to take that in your mind, but I see that in almost 8 times out of 10, or even sometimes, if all 3 are correct, most of the time they are explaining the first, if they are putting right. But no, don't just do that examination because I told you. So general trend I have seen, it's just a general trend. If all 3 are correct, then I did notice that this is not a reasoning question. In reasoning, most of the time that is incorrect. But in this, in the GK question, I have seen most of the time, if all 3 are correct, generally they are explaining the first. So you can take it. Sometimes it might not, right? But yeah, apply in an examination on your own risk. Don't tell me yes. हाँ नहीं ऐसा नहीं no ऐसा नहीं होगा ऐसा नहीं because something is true does not suppose just like that someone is very hardworking intelligent student, not necessarily they will be preparing for UPSC. That does not explain he is the UPSC. So these are two different things, right? Now in these 3 options, but generally I have seen it. The trend I told you, risk is up to you. Don't just click on my. I just told you the trend. Trend is that. Yeah, 2-3 questions together from that, solve it. And look,